What we saw in the third quarter was that global equities really benefited from that V-shaped recovery that we saw in economic growth. We saw broad-based gains across the world in equities. However, when you look in the US, we still have that same problem where there is a significant amount of concentration, and that becomes a risk to the US equity market. I'm going to show you two ways where you can really see how concentrated the US equity market is. In this first chart, it shows you that a specific select names that we talk about frequently, Apple, Amazon, Facebook, Google, they contributed to 140% of the total return we've seen this year in the S&P 500. Another way that we can look at that is if you look at the S&P 500 on a market cap basis, which gives all the names an equal weight in the returns. And what you can see in this chart is that that market cap weighted, which is heavily concentrated in those big names, is beating the equal cap weighted at the fastest pace since the dot-com bubble. This is concerning to us in the US market and only highlights why selectivity is extremely important in the US. Now, while we favor equities over the long term, over the next 18 to 24 months, it's very important to be selective right now because along with the US, a lot of the international markets as well are looking a little stretched. Right now, our recommendation within the US would be to go against the grain. It would be look at some of those value areas that have lagged in this rally. We like the small and mid-cap space as well because valuations are attractive and they have not rallied as much either. We like the developed international equity markets as well for a couple reasons. First of all, valuations are more attractive when you compare it to the US because they've lagged in recent years to the US rally. So you have better valuations. If you look at this chart, the monetary and fiscal response in the developed markets, you can see that some of the countries in Europe, Germany, Italy, the UK, France, as a total, when you take into consideration the monetary stimulus and the fiscal stimulus as a percent of their GDP, it's actually outpacing what the US has done. So we think this is supportive of the developed international markets. As I mentioned, we favor the global equity markets over the next 18 to 24 months, and we like them over bonds, especially since interest rates are so low. However, patience and selectivity is important, especially since we've had such a record run out of this pandemic bear market that we had. So be patient. There is no problem with holding an overweight cash position. Cash is key in this environment because we expect that volatility will remain heightened as we go through this choppy economic recovery. In that environment, we do expect pullbacks, and we will evaluate those pullbacks to put that cash to work.